Good afternoon, everybody, and welcome to another edition of Live Market Analysis. This time, it's all about the macro, everything big picture that's going on in the world that could trip up your little portfolio over here, perhaps on the ASX, perhaps in the USA, but commodities, global indices, foreign exchange, crypto, all that sort of stuff. My name is Carl Capolingua. I'm the market analyst at ThinkMarkets, and it is a pleasure to be with you. As we have a quick look at the rules of engagement today, pretty simple stuff. You ask me the questions, I give you my best technical analysis, and maybe draw a little bit upon some of my experience as an economist for the last 25 odd years. I've been working in the financial services industry. Let us head over first and foremost to the charts. I like to kick off our sessions with a bit of a whip around the grounds. And obviously, if you're watching me on any of the streaming services, you can participate as well. There should be a chat window somewhere you can type in your questions. So YouTube, LinkedIn, Facebook, and Twitter. Welcome. NASDAQ Composite. I do like to start here. You know, it's one of my favorite indices to trade, and it's been doing very well. And I've been doing very well on it, having called the end of the bear market back in about February. Go check the tapes. I was all over various financial media outlets doing that, both print and TV. And then a little bit later, probably around March, I think it was, started to say, look, I think we are starting to show signs that we're in a bull market again. And that is because the way my trend ribbons work, if you don't know what they are, they're over here. I won't spend too much time talking about them. I'll take them as a given if you're watching me in these sessions. But the long-term trend ribbons there, 144, 233s, they obviously tell me what the long-term trend is doing, the big picture stuff, and it works as a traffic light system. So obviously red is stop, amber is caution, green is go. We haven't seen a green since the bull market. You can see how well, obviously, the model works. In the short term, I've got the 2134s doing the same thing, short-term traffic light system. Obviously, that when the trend goes amber, and you've been in a bull market, you need to be a bit concerned when you break below the zone and then fail to get back above it, as in here and here. You need to be really concerned. In fact, I was in the media. In fact, go check the tapes. In the media, maybe it was here or here. One of those two things bookended it. I called the end of the US bull market, and I think maybe here the beginning of the bear. 100% nailed it. Again, hooray for me, right? But you can do it too. And I think that's the message. Anything I can do, you can do better by just using the model. So it was around here we started to get back above those moving averages and not only get back above them, but show that they are starting to act as a support point, a dynamic support point. So on the way down, they act as dynamic resistance. And on the way up, as we can see through here, they act as dynamic support. So that was the key. And we're through here. And long story short, we've gone back to green. So as long as that's green, as long as this is green, I'm pretty happy with this one. Now that's big picture stuff. Even the short term is still pretty big picture because the price action is really getting to the coalface of where we need to be. And to draw the price action in, it's actually very simple. The rules are very simple. High highs, high lows on each daily candle represents a short-term uptrend, and the opposite, lower highs, lower lows, represents the downtrend. Then we just link together basically those two conditions to get our peaks and troughs. And I can't draw this last one because I'm still heading up. I don't know where it's going to end. And this is what we need to watch for. Okay, everything I've set up to this point is the past. What's going to happen in the future? Hey, if we get back up here, let's call that scenario one. That's obviously continuing this great price action we have where we, let's go up here, let's call that scenario one. High peaks and high troughs, and not only just high peaks and high troughs, but the actual, the way they are sort of manifesting in relation to each other is very good. So this is what we call good price action. This is super important. Good price action because the motive faces are far bigger than the corrective faces. Okay, and that's so important because you might have something actually go up just as much. So we can say, and remember, technical analysis is all looking at historical data. So we might have had something that actually went up the exact same amount. But you can see here the motive phases and the corrective phases are actually far more similar. And whilst we started at the same point, ended at the same point, I would say that one is good price action and one is, let's call it not as good. Okay. And the more overlapping the price action is, the more not as good it is. yes, they've got to the same place, but we're talking about sustainability of the trend. So I would say the good price action trend is far more sustainable, likely to continue than the bad price action trend. Or maybe I didn't draw the bad price action trend as good as I probably could have, given the constraints of where I needed it to start and finish. But you know what I mean. You know, it's this really overlapping price action. And how many, I know you all trade stocks, I know that's probably why you're here, but how many times have you seen, and now I can say this is, look, we're still going up, so I can't call it bad price action for longs, but it's not as, we've got good, we've got not as good. Where am I going to go with this, ladies and gentlemen? Yoga? Is that where I'm going? Hopefully you're getting the picture here. Okay, what have we got? We've actually got pretty good price action because the motive phase is still very good. This last corrective phase is a bit disturbing, but what we can see is this last trough, okay, and obviously the V-shaped bits are troughs. I also call them points of demand, you know that. The last point of demand was at or above the sector from the last point of supply. So that's good. You want to see that. And you can see the good price action. See this last point of demand is always above its second from last point of supply, where it's here, they're overlapping. The old points of supply should act as points of demand. And in the mediocre and not as good scenarios, you can see they're not. And that is a problem for me. So we're okay. And scenario one is the best case scenario. Scenario two is going to have ramifications for your portfolio, whether you've got BHP, Rio, and 4 banks, or whether you've got Nvidia, Microsoft, or Apple right now. So this is what you want to watch out for, you don't want to see, is where we maybe do something like this, right? And we make the lower point of supply. So 13,865 is our point of supply. How do you know the supply there? We'll look at the chart. It's pretty obvious, black candles, and we came down. We don't want to see this lower point of supply because that would indicate to me that supply is building. How do you know supply is building? Well, the second point of supply is lower than the first one. It's the only conclusion you can draw. And or potentially demand is starting to give way a little bit. Demand is starting to lose its confidence. And then scenario three is so far down the track, we probably shouldn't even talk about it. But this is when we start to feel that we're in trouble, and Carl starts to stop saying things like we're in, just this fantastic NASDAQ bull market. And let's call that scenario three, but that is still some ways down the track. So hopefully we're in scenario one. We don't see any of the other two, but for now, I'm happy to stay the course. Just in the candles, that's the final flourish of my technical analysis methodology. I can see that we did have an upper shadow last night, which is somewhat disturbing, but I still think on balance, last night's candle was okay. Okay, I don't want to see upper shadows. I don't want to see black candles. Hey, I saw an upper shadow. I didn't see a black candle, so I think we're still okay. That point of demand is key. If you don't know what that point of demand is, I'll tell you what it is because it's not labelled there actually. It's 13,334. 13,334. Okay. So let's keep an eye on that. Just checking out volumes. I also do look at the volatility and volume. You can see down here the ATR1. You might say, hey, why ATR1, Carl? Everybody else uses 14. I use the 14 or a longer period for setting stop losses. I don't use it for finding trades. I want to see that ATR. I want to see this as raw average true range, raw volatility, average true range per day. I'm looking for volatility spikes. I'm looking for volume spikes to give me further information about what's going on. For example, we hit some supply here. Plenty of demand in the system up to this point. How do you know there's plenty of demand? Well, look at the bloody price. It kept going up with white candles and lower shadows. Then you hit this candle on big volume, and it tells you a lot of that demand was satisfied by a lot of supply. You could probably expect with that demand now satisfied that it'll be harder for prices to maintain the momentum because we have to wait at some stage for fresh demand to come in. And that's what that next point of demand represents, that fresh demand coming back into the system. Okay. Interesting here. What do we see? Well, there you go. Another big push potentially here, probably to get rid of some of that supply because of the next day we went back up again. Look, there's nothing in there that tells me that we're going to see scenario 2 or 3, so let's stay the course on that one. And then you can extrapolate that out to all of your other indices. I won't spend long looking at the S&P 500. I'm just going to mention it because the dynamics are very similar. You can see here to the NASDAQ. Actually, a little bit more disturbing because last night's shadow was more significant. That upper shadow represents a bit of excess supply in the system. I do like to look at the equal weight. That's encouraging. Okay, so maybe we're seeing a little bit of rotation out of those big capitalization stocks into the rest of the market. And the evidence here is the lower shadow, not the upper shadow, but the lower shadow on that candle. And actually yesterday's big white candle is far superior to anything we saw on the NASDAQ, anything we saw on the S&P 500 itself. So actually that's quite encouraging on the equal weight. And the next place I'll go is the Russell, because now we're looking at the smaller capitalization stocks, and that's the RUT there. And in fact, that's, look at that. Not just a lower shadow, but a white body as well. So I reckon, I didn't do it for you today, but I reckon if I ran the market breadth scan on my usual NASDAQ that I run it on, I reckon the breadth broadened out better than you might think. So actually last night's candles looking quite constructive for a sustainable rally. Potentially a rotation out of some of those big cap techs into the everything else universe. And we can also look at the mids giving us the same sort of information there, and the S&P 500 smalls. I'm pretty happy with those. I'm going to head over here, and then we'll maybe move away from stocks to some other asset classes. Looking at the banking sectors over there in the US, we've got the bigger banks, and then we've got the smaller banks. And look, neither of them are looking fantastic. And as I said to you, if we're going to see a calamity sometime later this year in US stocks, it's going to come from either of those two charts, probably this one, the regional banking sector. Not great candles last night at all, but no panic stations just yet on the candles we did see. And then we might actually have a look at the VIX, continues to trend lower. I don't think there's anything to be too concerned about there. And then we might have a look at the SKEW and see, check out this sort of risk aversion activity or hedging against the black swan event. And actually that started to pull back a little bit with the pullback in stocks lately. Okay, heading overseas now, we'll have a look at the German DAX over there. We're just looking for anything that might upset the US apple cart. Wasn't that long ago we made record highs here. I'm encouraged, I think, by some of these lower shadows. 3 in a row, in fact, and probably could see the DAX continue to move higher, in line with a very loose little channel there. So nothing to worry about there. In Asia, the Nikkei continues to do well. Wow, that's a big and important candle yesterday off my light green zone. So if you were that way inclined, I can't see any reason why you wouldn't go plus 1/3 based upon that candle. We did have a plus 1/3 not on screen for some reason, but go check the tapes. It was somewhere back here. I'm going to say 29,500. Maybe we had one here as well, because that's your other buy signal. So if I'm not around and you are around, these are the sorts of patterns we're looking at. Maybe not this one. So I'm going to go a little cross on this one, and I'll tell you why in a second. But certainly this is a Y for a yes and a Y for yes. And I think, today I'm going to, So, and the reason why this is a cross is I don't like this candle here. See that big black candle? And that just gives me a little bit of cause for concern about the amount of supply at that level. And now I'm sort of looking at this one here, and there's 2 black candles here. I'll leave it up to you. Second thoughts, having second thoughts about this one. I'm going to leave that there, because really all we're doing in these situations is dipping the toe in the water, which if it finally appears on screen, like I'm trying to make it appear on screen, that's all you're doing there, because we don't charge into any trades. I always say, if you are looking to apply capital, it's up to you, of course, it's your business, general advice, but divide what you intended to apply into 3 parts, and that's how you go in. And if it gets better, then you can always apply more. Look, I'm going to leave that there, as I said, simply because it is just such a strong candle here. But yes, I do have some tiny reservations about the severity of those black candles. Apart from that, let's head over to China. We can see that we've had a little bit of a bounce over the last couple of days on the back of some more talks by Premier Li about how well actually the Chinese economy is doing in the second quarter compared to the first quarter, and reiterating their 5% growth target. But still, the trends are very much set to the downside there. I wouldn't get too excited. And that also is looking like a very muted bounce. If I head back, actually, just to go and show you a few more of these indices here, I'm going to head to, not there, sorry, to here. And I want to show you the indices over here and have a look at some of these indices. So we're going to get live updates now, and stocks have begun trading in Asia. So we can see the big pop up here on the China Mainland Real Estate Index on Premier Lee's comments, and a little bit of a return back to the downtrend from there. And there's the extra update that we didn't have in the previous chart I showed you on the China A50 shares. This is the key index to watch for China. So if you've got BHP, you've got Rio, MinRes, and a lot of those big commodity stocks. If you're a bit of a copper bull, I know I'm going to look at copper very, very soon. I know so many copper bulls out there. I watch a particular local media outlet in Australia, which I love to watch. It's always on in the background. And I heard somebody again talking about copper. Do you know how many times I've heard people come up on this particular media organisation and talk about copper, bullish on copper? And I just get really bored, actually, because I'm looking at charts like this and I'm thinking, you've got all the great ideas in the world, but you're kind of ignoring what's happening in the price. And this is not the copper chart. I'll get to that in a second, but it's hard to see some of these industrial commodities, bulk commodities, do well in the face of a crumbling Chinese stock market under the weight of really the burden of this China property sector. And we're still waiting for some really decisive stimulus. And I'm not saying it can't come. I'm not saying Beijing won't do it. I think the indications are growing that they may actually surprise us to the upside. But it would be a surprise, because I tell you what, the market is not feeling the love just yet, despite all the hype and rhetoric. I have talked about stock indices. I will talk about commodities in a second, but I just want to talk about what's happening in the bond market, because it's going to shape our conversation about foreign exchange. It also shapes our conversation about equities as well, because obviously the higher interest rates are, typically the worse it is for our stock portfolios. You can see US rates just flattening out a little bit there, but still, short and long-term trends very much set to the upside. We have seen Aussie yields bump around a little bit. Yesterday, quite a sharp drop on the better than expected CPI data, but today, quite a sharp pop on some very strong labour data and retail sales data also. So bit of a state of flux there on the Aussie, and we'll see how that relates back to the currencies in a second. And then the sterling is the key one for us, because we do have that sterling yen trade. Many trades I've talked to you about against the yen that have done so well. Bit of a pullback in yields there, so we might see when we get to the currencies a bit of a pullback in the sterling yen, I wonder. The Japanese yen, actually, some of those rates have popped very slightly, but nothing to get concerned about, as you can see by the scale there. It's minuscule and it's negative. Let us head over I want to talk about the commodities. I know I've got some questions there, but I'm just on a bit of a roll here. So let me talk about copper, because that's the topic of conversation. Oh, lo and behold, who would have thunk it, ladies and gentlemen, that the copper chart looks almost identical to the China A50 shares chart. I mean, who would have fathomed it? Really, really. So I'm just waiting for the stream to catch up to make sure I'm still going live. Pardon me for 1 second. I think that's all functioning. I was talking to you about copper. So I'm not saying we can't have a bull market in copper bulls. Okay, I'm not against you. Don't shoot the messenger. I'm just saying I can't see the conditions to support your bull market thesis at this point in time. I had a great rally through here, and this was on the rumours. Again, that rumour mill cranking up that we were going to see significant. I heard talk of over a dozen, up to 20 individual stimulus measures, and that's what drove copper prices through here. Prior to that, they completely tanked. Why? Because go back to those China stock indices. They were tanking. And here we are. This is the disappointment, because really all we've seen on that China stimulus is a bit of tinkering at the edges on a few of those key policy interest rates, and even then only at the tiniest amounts, 0.1%, and the market there showing its disappointment and reverting back to the long-term trend. Please, 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 if there's anything you're going to take away from today's, you might have the greatest thesis, the greatest vision for a particular stock or commodity or theme, but if it's not supported in the price, I think that is faulty thinking. Iron ore is always a curious one. It's done better, to be fair. It's done better, but under a bit of pressure here at that long-term trend. I wonder, that looks far better than copper. I wonder if there are some underlying market fundamentals there, seasonal factors potentially, supporting that iron ore price over, say, the copper price. It's probably worth skipping back to here where I can show you a few other important industrial metals, and we will head down to the London Metals Exchange charts and turn that on, and you can see that aluminium just continues to be eroded, isn't it? Be eroded by this negative sentiment surrounding global growth prospects going forward. That's LME copper. You can see that's pulled back as well. And then we get to something like nickel, which has completely broken down. And again, a lot of rhetoric out there, a lot of talk about nickel prices and nickel stocks as well, but I just can't see it. Can you see it? If you can see with a bull market there, please let me know. And I know there are very few stocks that are probably exposed to, say, lead. Actually, that doesn't look half bad. Tin, actually not that bad either, but zinc, getting to zinc, looks pretty terrible also. And we are going to finish off with a quick look at our lithium commodities here. We've got lithium carbonate. This is the contract that trades in China. Therefore, the scale over there is yuan per ton, so about 300,000 yuan per ton. We saw that big drop through here, a bit of rationalization really, and a bit of a pricking of the bubble prior to that, where we did see a bunch of those big Chinese battery manufacturers start to heavily discount prices because some of those government subsidies over there in China for electric vehicles were discontinued, if that's the right word. And really, they ended up with too much stock and not enough demand. They did end up putting a price floor on it, like a self-agreed within the industry price floor around 250, and it was a bit of a delayed reaction. It happened around here, and then eventually the market kind of responded. We got rid of that supply overhang. We started to move back up, and I said a V-shaped recovery is good. And I'm just talking, look, I'm not an expert on the underlying fundamentals of lithium carbonate. I'm not professing to be that. Please understand me. I'm a technical analyst, and what I do know is that V-shaped recoveries in technical analysis are great, are fantastic. You've got a much better chance of getting all the way back up to the high if you have a V-shaped recovery. But the problem is the V is, well, is it a V? It's just starting to roll over again, and the price action here tends to be quite consistent. You're either moving one way or the other, and I have said to you the next move in lithium prices I think will be the decisive one for the medium term. I'm saying for the next few years. I'm not saying for the next 10 years, but for the next 18 months potentially. If it starts to push back up again through 350, I reckon this lithium bull market has got almighty legs. But if we start to roll again, and I'd say if we start to get back below that floor at 250, I think we've got some serious problems here with this lithium bull market thesis. And certainly if we start to create a trajectory towards 250. I think you're going to start to see that in your local lithium company prices as well, your Pilbara's, your Allchems, and I'm forgetting all the other ones, Core Lithium, for example, IGOs perhaps. And IGO is an interesting one with that nickel price also getting hit. Lithium hydroxide looking a little bit similar. It didn't get hit as hard, but probably didn't rally as much either. And also just starting to see the slightest inkling of a rollover in prices there as well. And just to head off, I know this, Jill's already put it in there. I suspected that was coming. Uranium prices have moderated just by a tiny bit. But I think there's some encouragement for us uranium bulls out there that stock prices, I think, have been quite buoyant in the face of that little bit of a pullback. And we're going to have pullbacks. Nothing goes up in a straight line, but I don't think there's anything in that chart yet to suggest that it's anything more than just a little correction back to the short-term uptrend, which still looks very good. And the long-term trend is very much intact. And the key supply point and the key flipping point, the flippening, we've called it in crypto parlance, the flippening will come when we can get above this big point of supply up here. And that is around that sort of 63.75. So as we start printing 64, I think it's not just the true believers that will be believing in this uranium bull run. I think it'll be everybody else coming to that realization. Let's hope it happens. Okay, I think I did do the Forex, but I've got some coming up here from Daniel. So Daniel's got the first question that came in today. So it's a great little segue to take Daniel's lead there and head back to the Forex, and that will probably complete my big run around the markets wrap up. Actually, sorry, Daniel, just give me one more second. So I want to talk about the energy commodities, and I probably should talk about gold, which I'm guessing it will come up somewhere as well in your questions. About this, I've got a question about energy commodities coming from Kirsty. So let's look at coal here. And I'm just going to change that to a line chart so it's easier for you to see because we only get the PM fix. And this is the Australian premium coking coal futures that trade on the Singapore exchange. So this is the coal that goes to Asia. It goes to Japan, South Korea, and China. And we can actually see a little bit of a bounce there. And that is more than likely to do with, again, that those China stimulus hopes. We've seen the price of iron ore rise, and I think that's helping coking coal here, but hardly coking coal here. There we go. Sorry about that. That's your chart of coking coal. Hardly a glowing endorsement though, because the long-term trend is still terrible, and the short-term trend actually amber. There's some encouragement there, but not getting too excited. Let's head over to the Newcastle coal, which is your thermal coal now. This is the one you use for energy production, and you can see that is just a process of normalization. I think after what was an extraordinary period of time, spurred, of course, by partially supply shortages due to COVID, supply chain issues, labour shortages, some weather events through here, and then exacerbated substantially by the Russia-Ukraine war. But we're seeing a normalisation here. And look, this is kind of the key level, isn't it? Around that 130. I've said this to you in the past. If we break through here, then I think the long-term fair value for coal is probably at best around that 110, but probably more into that sort of 100 level. So I can't see any dramatic increase in coal prices coming anytime soon, unless there is a major shock to the system. Also probably worth talking about your Brent and your West Texas crude oils here. And we've had lots of discussion, haven't we, about inflation recently. And it was a wonderful discussion. I don't know if you follow me on Twitter. If you don't, you should. But I had so many people respond. I put out a little alert when the CPI, Aussie CPI broke yesterday. And I said, way better than expectations. And it sparked this massive, massive debate from you all about whether the RBA should increase interest rates. And it's just so wonderful for me as an economist to see just everyday people just wanting to know about what's happening with interest rates in the economy and just talking about it. I think it's fantastic. And it was 50-50. 50% of you said, hey, no, that's it. RBA's got to be done. And 50% of you said, no, they've got to keep going. Inflation is not under control. That it was the trimmed mean. Once you add back in the fact that gasoline prices fell substantially, that's the one that the RBA should be looking at. And I put to you that, well, actually, I think the headline is a better gauge of what's happening in inflation, because I do think we have begun a substantial deflationary, that's the wrong word, disinflationary process, but it could lead to a deflationary process if the world does find itself printing recession numbers. And also China, if you have a look at those Chinese PPIs, the Producer Price Index, they are actually showing deflationary numbers there, and China could be a key factor in exporting some of its deflation or rapid disinflation to the rest of the world. We're going to see some of it coming through in lower commodity prices. Yes, commodity prices, but particularly here lower energy prices as well. So Brent crude, I can't tell you that's going up. I certainly can't, because if anything, I just think that looks like it's increasingly looking like an almighty short, and OPEC be damned, dare I say. This, I feel, is going on. We could see a print with a 5 in it. And then, the whole supply chain changes as those gasoline prices come down. Look, haven't seen it yet in RBOB. I know we're getting way off topic here. Hopefully this is interesting for you. It's interesting for me. But RBOB is literally the gas you put in your car. So what does that cost? And we can see it has held up really well. So obviously with the crude, the crude prices coming down, we're seeing refiners, I think, making a bit of money here. But eventually I think that will break, and probably the break will come at the end of the US summer driving season. And we may see lower prices, substantially lower prices here towards the end of the year, which again, I think supports the thesis for lower, not higher rates down the track. Stock markets love a peak in rates. They love that, and stock markets will rally even if there's a sniff of a recession around, because they are looking forward. Okay, I think I've talked about a lot of the stuff you've talked about there, Kirsty. There are certainly cycles. We tend to see. I'm trying to remember. I won't speak out of hand here because I'm trying to remember a seasonal chart for crude oil I did a few months back. So let me go find that chart for you, and I'll pop it up on Twitter and try and answer your question about energy commodities seasonality that way for you, okay? Simon, again, this is coming from YouTube. Can I have a look at the ITB and XHB ETFs? These are relating to which indices? Tell me which indices they relate to, Simon, and then I'll look at them there. Otherwise, ask about those if they're listed in the US tomorrow or listed on the ASX on Tuesday. I'm going to head to the FX as I promised a long time ago after I look at gold, which continues to disappoint. And let's quickly head back here and head back to where I've got all my scratchings on my gold chart. That's why I'm going back here. And is it on that one? Yes, it is. There we go. So we've been look, bearish is not the right word. I don't think you can call me a gold bear. I'm just the opposite of, no, I was going to say the opposite of bullish. Okay. I'm not a bear, but I'm neutral. Neutral is the word we've talked about. I think we're just don't care. We just don't care about what's going on here. There's nothing to see here. There's nothing to do because this short-term trend is just so well entrenched with these black candles, lower peaks, but the price action is not great to the downside. Downside price action, that's not, you can't even see that. Let's do it this way and change the color there. So this is the downside price action you want to see, right? This clean movement to the downside. And we're seeing it's a little bit clean through there, but just so overlapping through here. And then we've got the long-term uptrend. So look, I'm not a gold bear. What would turn me into a gold bear is if we really decisively broke below that long-term uptrend zone started to turn amber, and we went through one of those, obvious trend-changing patterns. And you can see here, don't muck around with my trend zones, ladies and gentlemen, because if it did go amber, you break beneath it, you just fail to get back above it. As I've said many times, expect lower prices, and then you change back the other way. No big deal. Went back to amber. We stopped being resisted by that zone. We started being supported from it, and it was around here I told you to buy gold, and that wasn't a bad call at all. Ho hum, let's keep moving. There's no trades there to the long side or the downside. I think silver looks worse than gold. In fact, because these are updated manually, let me get that out of the way. These zones updated manually. So really, I haven't done it for a while, but you can see that we actually are amber now on silver. That's a problem. And we're being resisted by the zone. We're not being supported by the zone like we were here. We're being resisted by the zone. Look at that shadow there, that upper shadow. So that silver's concerning. And silver's typically considered to be a higher beta play than gold. So maybe silver is leading gold here. Maybe. I don't know. I don't know the future. I better stop talking and start answering some questions because Daniel's been so patient. Let us head over. I was in the right place. Let's head over here. And we're going to look at the AUDUSD, an obvious place to go given some of the big data we've had this week. And it would appear on face value, we saw Aussie bonds rallying on today's data, the retail sales and vacancies, job vacancies numbers. But you can see how little the response is in the Aussie dollar, at least yet. Now, all we've got is trading in Sydney, a little bit in Asia. We need to see what happens in London and then in New York tonight, and that'll really paint that candle properly. But I would say the response so far is extremely muted. So I think the market is more focused on what the CPI data told us yesterday than what the dovishness of the CPI data compared to the hawkishness of the two data points today. So I would suggest to you that not a lot has changed with respect to this. Okay, so we're looking at July meeting probabilities for the RBA. This is on Tuesday next week. And as of yesterday, X post that CPI data, we were 84% for a pause and 16% for a hike. And that pause really reflects, you see the big shift on 19 June to 20th of June, 49 to 51, 19 June, and then we get to 68, 32 on 20 June. And the reason for that is that was the release. The 20th of June was the release of the RBA minutes for their last meeting, which was earlier this month. And the minutes were said, the participants were finally balanced between hiking or pausing. So you can see just the huge shift there, and then really it's continued to converge towards a no change. And I don't think today's data is going to change that, but hey, we'll get a print on this later on today. We'll know for sure. So I think with, generally speaking, Aussie rates moderating a little bit, and you can see there I tweeted this yesterday, but just very quickly, pre-yesterday's CPI, we were topping out at 4.2% in December, and no rate cuts on the horizon. To post-CPI, we are now topping out at only 4.45, if you could say only, in December, and we're actually now getting a 5 basis point cut on the edge of the chart there. Fed probabilities while we're here, looking at today, or based on last night's close versus a week ago, we're still actually pretty much on track for another hike there from the Federal Reserve. That's market thinking, and we continue to factor out the possibility of a hike later this year. Okay. Well, there's been a little bit of a change there, but nothing to suggest that we're going to get a hike later this year. Okay. So with that in mind, let us head back here to the foreign exchange outlook for the Aussie dollar. I think it's weaker. I think this was a bit of an aberration, a bit of China stimulus, perhaps, a bit of RBA head fake. And I think this is probably the move to watch now. Is it something I want to trade? I'm not so sure. I think it's still very much sideways. What would get me interested in trading? If we saw perhaps this sort of a move, well, it's hard to say. I mean, that's a pretty bearish candle. Look, I'm going to draw it because this is what I'd rather see. I just want to see another. This is all. Well, there's a little peak in there actually. I was going to say this is all one move, but there actually is a little peak in there. So I want to see the price action. That's where I'm going with this. That's not what I want to draw. You can tell I'm terrible at drawing in trade views. Some of you are no doubt better than me at doing this. You're probably screaming, hey, Carl, you need to do this and you need to do that. But I'm going to do my best at trying again. That's the one I wanted. So we actually do have the lower peaks and lower troughs. So in that respect, I probably don't need another one. I just wanted some confirmation beneath the long-term trend zone. Okay, and it is actually there, to be fair. There's a little confirmation. Okay, well, I'm definitely still considering shorts, not longs. Would I get in? I don't know. You've got me here, Daniel. Let us see. Look, we've got a great indication yesterday, great showing of supply. You can see this upper shadow and then the follow through. So this is all good. Very decisive through here, shallow rally. So look, we're very close. Let me just see. I know this might sound like a little bit of a cop-out, and I accept that accusation. But let us see how today's candle goes. Okay, so we've got this big supply event yesterday, and today's candle is actually shaping up really well. So we're pushing back into the range. We didn't get more than 50% back up that range to tell me that supply is still very strong in the system and demand is quite feeble. The short covering potentially, sparked by the better than expected data today, really didn't get very far. So there actually isn't very much short covering. Markets still want to be on the short side. But as I said, London, New York, this candle is still trading. So if we finish with this candle, a candle that has a very small body, white or black, I don't mind, preferably black, but very small body and a shadow that is obviously pointing up, no higher than say halfway up the range of yesterday's candle, then I'm going to go minus 1/3 on this and look to take shorts on the Aussie. So minus 1/3 if, let me say, candle confirms, right? But that's up to you. That's your homework to keep an eye on that. Now, Daniel also asked about the GBP CHF, not one I'm familiar with, not one I've been tracking actually, and not one I reckon I even have in my, that's how little I track that particular pair. It's not even in my list. So let me try and find it for you. GBP CHF. Not sure why you'd want to trade this one. I'd have to go check the relative interest rates, which I think are very, very similar. Like the interest rate dynamics in the UK and in Switzerland are similar. They're both increasing rates. Probably the UK going to increase rates more than the Swiss National Bank, however, and that's why we're seeing ever so slight uptrend. But this looks extremely flat to me. It's not a currency pair, as I said, I would ordinarily think of, simply because of the interest rate dynamics between the two countries. And I can't see any decisive trends there for me to get too excited about, Daniel, to be honest. The ones which I have been getting excited about are the yen crosses, because we saw how low those Japanese rates are, and we know rates are rising everywhere else. But we said that the sterling yen might have a little bit of a problem last night, because we saw a bit of a pullback in those UK rates. There might have been some data there, I didn't see it. And what we are seeing here, ladies and gentlemen, is how FX works. I keep saying this to you, and there's so many TikTokers and influencers out there that think they know how FX works, and they'll talk to you about the RSI and the stochastics and the MACD, but they are clueless. FX works based upon relative interest rates. If you can get more yield in one currency than the other, that currency is going to be going up against the other currency. Okay, so I've been telling you now for weeks, this is the place to be, and wow, it has been probably one of the best trades you could have taken in global assets anywhere. I hope you did. Last night's candle, if you're on it, I don't think is a reason to get out. It's not a great candle. Make no mistake, we don't like to see black candles, but I don't think it was black enough. I don't think it was substantial enough to say that the substantial demand in the system has or is being overwhelmed. Not to say it can't get worse, okay? But I think you can trail stops up. You can get under here, say a 179.67 on that one. I don't think you need to go any closer than that for a manager exit minus 1/3, and until then, stay the course. If you saw another big black candle maybe that didn't quite take that level out, you could get out in advance of that, and maybe that would be your second exit. So minus 1/3 on a big black candle, and then minus another third there, and you've only got 1/3 left based upon the fact that you should have some skin in the game on a trend that is so substantial, okay? Because there's every chance you just get a little flip like this, and you don't want to be just getting out on the first black candle and then, cutting yourself out the trend. And this is another good example here of why you're not getting out of the whole lot. So that one's gone really well. The other one, which we've been looking at, in fact, I put a trade on a couple of weeks, is this one here, the US dollar Japanese yen. It's probably worth, just as a follow-up, just as a case study, to see how that one's going. You can see if I click on that, this is the trade we put on live in session. And I wonder how many of you went and did the same thing after the session and said, oh, look, you know what? I only needed, I think it was a $30 margin or something to do it. I think we worked out our risk, it might have been, I can't remember, $80 or something. And I'll give it a go and see how it goes. Now, this is a demo account. Don't worry, it's not real money, but it's gone really well on all of 0.3, 3 micro contracts there. So it just illustrates that, this is stuff you can trade, you can get involved in if you know how to read a chart effectively, and that's what I'm teaching you how to do, and then how to get out. So what I want to talk about today is trailing a stop loss, okay? This comes back to our tradecraft. And I can't see anything in these candles to suggest we can't keep this going. Why wouldn't we try and turn this 113 into $213, okay? I do want to trail my stop loss though, because for two reasons. There are we got in around here, somewhere around here. Maybe it was in this candle, I can't recall exactly, but we got in on this breakout. And we can see that we've got a little point of demand here. Okay, so, and then there's a couple of interesting little candles here, a little lower shadow here. I'd say that's a sort of intermediate point of demand. I'm just looking for places, if I need to, I can trail my stop loss to. So certainly under here would be a place I'd be looking, but that's quite an aggressive one because there's no clear point of demand supporting it. And this is the most obvious one, okay? So which of those two candidates is the best place to go to trail a stop loss? And I know you probably know it on this one, but we're just looking as a hypothetical example because you might find yourself in a chart that looks like this. Okay, so I need to zoom out to understand which of those two possibilities is the best one. And because it comes down to reward to risk. What have I got left in the trade? And I think we were targeting an area around here, weren't we, with the trade? And I deliberately said I won't put a profit target in because I will wait till I get to that area, that potential area of supply. And I'm probably a little bit restricted here by being in this chart because I can't draw. So let me head back to the other one where I can draw. And we can see here that we've got all the same stuff. So the ThinkMarkets chart's the same as the other, the trade view chart, obviously. But what I want to do is maybe grab some of these guys and say that the old point of demand could well act as a point of supply in the future. Plus, you've got the most almighty black candle here, which caught the market out. We could this supply through here could well manifest itself back here, but it's a total unknown. We don't know if that's going to occur. Who are we to say that our analysis is the right analysis? We think there should be supply there because there was supply in the past, but who cares? I mean, we care, but who else cares about it? And this is why I don't set profit targets. What I will do is I will wait. I'll follow the trend and wait till I get into this zone and determine based upon the price action if there is supply in that zone. I want to see how the potential supply manifests itself or doesn't manifest itself in the candles. If I start to see the black candles here and the upper shadows, guess what? I do have that supply. It is there. It's not just me worried about it. If I see white candles in there, I'd be so annoyed with myself if I put a profit target on and got out on a big white candle. Okay, so I'm just going to let the candles do the talking, but respect the fact that I could see supply here. And if I'm here and maybe I see supply here, well, do I really want my stop loss all the way down here? Do you get where I'm going with this? Because this is my upside if it goes wrong, and I don't know if it's going to go wrong, but just in case it does, and this is my downside. This is how much profit I'm going to give back on the trade. Okay, so this area here, that's why I just pointed out there's two lower shadows and this big white candle. There's plenty of demand in here. If we trade back below that point, that demand is gone, and that's a reason why I should be out of the trade. Okay, and the benefit of getting that tight, just a little bit tighter here, is it just evens up my reward to risk. Not quite 1-to-1, and that's not a prerequisite for me, but as tight as I can get it, as tight as I can get a sensible stop whilst just trying to manage that potential reward to risk. And I don't have to have 1-to-1, because who's to say we're going to stop here? Who's to say? Are you to say? You think we're going to stop? I don't know. Are we going to stop there? So it's a great little case study in how to manage your trade if you find yourself in a profit. Wouldn't that be nice? And then on the platform, you can see here I don't have a take profit. And if I click that, it allows me to set a take profit, right? But I'm not going to do that. But I do want to manage my stop loss. So if I click on my stop loss now, I can move this up. And I can just go on the chart here, and I can just grab my little grid there, and I can go, that's about 142.66. I don't want to set my stop loss at 142.66. I want to go a little bit lower. I'm going to go maybe say a 142.37, I think is a pretty good stop loss. So if I go 142.37, double check everything is right here. I don't think I need to do anything else. Click modify, and it's changed there from whatever it was previously. It was in there, it's gone now, I can't remember what it was, but now it's at 142.37, and if you can compare it back to my entry price, worst case scenario here, I make a profit on this trade, okay? And if I love it when I get into that situation, because now I don't care what the trade does. Honestly, US dollar, Japanese, you can go up, go down, who cares? Whatever, I'd love you to go up, but hey, I'm going to make a profit. It's the best feeling in the world when you get that stop loss nicely, not just a little bit above your entry price, but nicely. It's great vindication. So that is a great case study, I think, in trading FX. If you don't trade FX, you should trade FX, and we're on screen. It's a great platform, a great place to do it. Okay, Perry also talking about some FX, saying the yen is still weak across the major currencies. I agree with you, US dollar, euro, and Swiss. Stay the course on those. Swiss yen, let's look at Swiss yen, and then Aussie CAD as suggested. So we're going to head back over here now. Yes, over here. And we're going to look at the Swiss yen, which is still going very well. No complaints there. In fact, it's actually, I'm going to say, beating the sterling yen, at least in the last few candles. Stay the course there, Perry. Perry knows the drill. Unless Perry sees a really sinister candle, Perry knows he's going to stay the course. Could you get in now? Look, I'll leave that up to you. Everything's fine, but we have to agree there were better places to get in with these white candles at the light green zone. I mean, here, this candle here is the monster, isn't it? Okay, but as I've told you many times, Perry, understand if you're on the Swiss yen, you're on the sterling yen, you're on the dollar yen, they're all the same trade with just slightly different twists on them. Okay, so just understand your risk there. Okay, not saying you can't do it, just understand your risk. I don't think I have the Aussie CAD in my list because it's not one I regularly trade, and there's a good reason for it. If I zoom out, you'll see. I mean, it looks like it moves a lot, but it actually doesn't move a lot, and the reason for that is we find historically, over and over again, and I can go out to monthly chart here, and we're probably not going to find a lot of movement. We haven't seen a lot of movement on this for a very long time. Look at this, is 1980. There you go, Perry. Perry's saying potentially to short the Aussie CAD. Look, you can if you want, but the Australian economy and the Canadian economy are so similar that investors simply lump them in the same basket. And they say similar things are going to happen to them, and therefore interest rates in those currencies are going to tend to be the same. And whilst this looks volatile in the short term, it has moved actually very little, relatively speaking. Certainly the Aussie dollar to say the US dollar over time, or the yen over time. So I'm going to pass on that one. Yes, it will probably go down. Maybe there's a few figures in it, okay, a few round numbers in it. But look, I can't see any reason why you couldn't. But it might not be the most effective tool. Look, it looks fine. You got a bit of a point of demand here, don't you? Okay. We talked about a very similar sort of looking chart with the AUDUSD. From Joey. Hi, Joey. Hi, Carl. Can you also please include the Hang Seng? Yes, we absolutely can. And I'm not far away from it. If I go to over here, and that's it there, the Hang Seng. Looks pretty awful, doesn't it? I mean, it's obviously reflecting what's happening on the A50 there. Very similar charts. A50 looks worse. Also, we've got these are not Hong Kong stocks. These are mainland property stocks. And then you've got the other property stock indices there. So just showing you what it's trading on. Well, I think this is a short for me. I can't see any reason why you would be long this. It looks pretty solid actually, but understand, Joey, and this is the frustration I have with some of these charts based upon China, is that we might see something from Beijing, and then boom, you have 3 weeks of short covering and everything goes up. But I agree with you. Short-term trend is down, long-term trend is down. I think it has broken through here. We're failing at the short-term trend ribbon. And then today's candle, I think if it can close black like that and at the lows, and even if it closes below there, even better, this is kind of your signal for a continuation pattern to target, at the very least, this area here. And maybe you could run a really tight stop. I certainly think you get 1-to-1 in there. So if you wanted to go a plus 1/3, and of course when I say plus 1/3 here, it's really a minus 1/3, isn't it? But it's a short trade, not going long. Then I've got no objections with that. If that last candle closes that way, of course, it's still trading right now. And Joey explaining, Joey's already short. He's already short. He's all over it. I think I've answered your question. I've done Jill's uranium. Barry saying, agree on interest rates. Low should cut next month. I don't think he's going to cut, but I don't think he's going to hike. So therefore, the pause is the most obvious scenario. Joey also saying, sorry, I'm using 3-minute charts. Oh, okay. 3-minute charts. Well, that's different. Look, I think you're fine on the daily chart. 3-minute chart, that's a bit extreme for me. I'm not a 3-minute chart trader, but I'm happy to look at any time frame you want, really, in these sessions. This is your money, your call, so to speak. Look, I think ditto. I mean, it looks actually quite similar, to be fair. And there's your target down there. So no objection. All my rules are still the same, Joey. Price action, trend. The trend ribbons work here. You can see the trend ribbons work here. The traffic light system works here. It's absurd. It's crazy to think that it should do that, but it does on any time frame. You find, look at that. It's just, I was about to use the word magic. There's no magic there. It just is. So this could be a daily chart, couldn't it, ladies and gentlemen? It could be a daily chart, but it also could be an hourly chart or a 4-hourly chart or anything you want. The methodology works because the methodology is sound. It's simply trend following with price action and candlesticks. It doesn't get bogged down with silly indicators which try and take your attention away from what's happening on the bloody chart. Okay, let us, how are we going on time? Well, we're getting pretty close to time, but I reckon, Simon, US house builders, ask me tomorrow, Simon, please. And Sudesh asking about the US dollar, Japanese yen. We've done that one. What I might be able to do for you, Simon, is look at the chart of lumber. Have I still got this? TradeView used to have a really good chart of lumber, and then it stopped working. That's a 3-minute chart, so we're going to get out of there. Look, that's impressive. A bit of a rally there on lumber. Obviously, that one of the biggest consumers of what this contract represents is that US housing industry. So that's certainly turned off the low. I'd say it's still in a long-term downtrend, but a bit of a sketchy chart there. So that's probably encouraging for you there. But Simon asked me tomorrow on that one. Happy to cover it. I have actually done. I've done met coal there for you, Roberto, earlier on. I have done everybody's request. So in the absence of any further requests, and you can put your last ones in, please, I do want to tell you about the Traders Summit. And I know to these sessions, because we talk about international markets, I've got people listening all over the world. So if you do happen to find yourself in Melbourne on the 22nd of July, please get yourself to the Melbourne Marriott Hotel. You can catch myself and two of my really, really good friends, trading buddies for many years, Jason McIntosh from Ocean Trader and Kel Butcher from Amplus Capital. Kel's written many, many books. Some of them you probably have on your bookshelf. 20 Most Common Mistakes and How to Avoid Them is a ripper. You should own that book. Jason has worked at Bankers Trust. He runs his own advisory firm now. And of course, little old me. And we're going to talk about some great stuff. I won't go into the topics, but certainly I'm very, very confident you'll learn something about being a better trader, really. It's free to join and no strings attached. Just come and listen to us. We want to get out there and do some things post-COVID and see if people actually turn up in person instead of doing the boring old webinars and things like that. That's how you do it. If the link is here, I'll also put it, pin it onto my Twitter. So it'll be not there. It'll be pinned into my Twitter and you can find it that way. Let us then adjourn for the day by saying that there's the Trader Summit. We've talked about that. If you want to talk about the Aussie stocks, hit me up on Tuesdays. We do them in a webinar there. And then on Fridays, tomorrow, we'll do the USA shares and ETFs, of course. If you're not trading with ThinkMarkets, you really should be, because we are the good guys in the broking industry. Wherever you are around the world, you can trade shares with us. We do have offices all over the world, and we're regulated all over the world as a result. But really where we excel is in our CFD products, our contracts for difference, because they're the ones that really have replaced those traditional futures markets and options markets. CFD is the place you want to be trading anything from the world of macro that we talked about today, with market-leading spreads and commission-free if you do want to trade your shares. We're an award-winning broker. We continue to be nominated for them. We just got nominated for a Best Platform Award here in Australia very recently, because we do have the best platforms and apps, and of course dedicated account management with 24/7 customer support. I whinged during the week about how eBay has done me wrong and how hard it was to get in touch with eBay, because they don't have you can't go to their website and find their contact details. And I'm going to tell you, ladies and gentlemen, that you should really start, as I am going to do business only with businesses where I can find in 1 or 2 clicks at most their contact details. And let me tell you what is so wonderful about ThinkMarkets. I know it's not there, but you don't have to go far. Scroll down to the bottom and click, obviously, Contact Us. And if you click Contact Us, look at this. You get all of our phone numbers, okay? UK, Australia, Italy, Spain. Then there's some other ways to get, but it's not that hard to find us. And that is the best thing about ThinkMarkets right there. Ladies and gentlemen, it has been such a pleasure chatting with you today. I've had so much fun. I hope you have too, and have learnt lots along the way. All the best for your trading and investing until we catch up again. Bye-bye for now. I should have mentioned follow us and click the thumbs up button as well. And of course, I have to talk about the disclaimer, which says that everything we've talked about today is general in nature, has not taken into account your personal financial circumstances or particular needs. So before acting upon any of this general advice, consider it carefully or seek the help of a financial professional. You can learn more about ThinkMarkets and any of our products by heading to the local website in your region and downloading our product disclosure guide.